Welcome back. Now, your favorite chocolate treats may cost you an arm and a leg in the month of love. That's as cocoa prices, the main ingredient used to make chocolate, shot up to all-time highs. And joining me now to unpack the drivers behind the spike in prices is Commodity Analyst at Rabobank, Paul Joules. Thank you so much for your time, Paul. Is this a Valentine's month thing, or did this event just happen to coincide with the chocolate giving month?
No, this wasn't really planned for Valentine's Day, of course. This is a situation that has been ongoing for quite a while. And really it's to do with a lot of systemic issues which are really taking place in West Africa. So the top two producing countries, Ivory Coast and Ghana, we've seen production down there this year. But in terms of the futures price rally, what we really saw, it was about November 2022, we began to see prices move higher. And since then, they've just sort of exasperatedly moved higher and higher. And we've really seen this aggressive rally continue into Valentine's Day, and really since the turn of the new year, up about 22%. So huge volumes, and yeah, a really, really sharp rally, which has taken pretty much all the market and a lot of analysts by surprise.
Yeah. You talk about systemic issues, and is that just purely weather related, or are there other issues that exacerbate the situation?
Yes, so it's an interesting question, and that's a question that's caused a lot of debate in the industry. So there's some people who'd argue that we have had unusual weather this season, and that's been one of the main drivers for the lower production. But there's also other issues going on. So, for example, some people believe that what we're seeing is increased disease. So we see a lot of black pod disease and swollen shoot disease in both Ivory Coast and Ghana. Now, this is difficult to quantify. But to some people believe that what we could be seeing is pronounced drops in production because of this disease, which some argue this season is a lot worse than what it typically would be. Now, if this is the case, obviously the way to treat this disease is to actually cut the tree out, plant a new tree, and of course that can take five years to fully yield again. So that's what I mean by this could be a systemic issue. If disease is one of the root causes of the problem, then potentially we could have lower production for many years to come. And really, there aren't many other origins that we're seeing increased growth, other than the likes of Ecuador, for example. But generally, we see all the production centered in one specific region.
Yeah, and it seems that there isn't going to be any relief anytime soon. And I see that it's not just cocoa that has seen prices surge, it's also sugar. Are these movements related in any way?
So you could argue to some degree they're related. One of the concerns and one of the reasons that we initially saw prices rise for cocoa, and actually why speculators and hedge funds began to invest in cocoa in 2023 and parts of 2022, was because of the risk of El Nino. Now, typically what you see is something of a correlation between dryness in West Africa and El Nino events. For example, we saw that in the 15-16 season, where we had a very strong Harmattan crop, which some believe is related to the El Nino. And again, we can also see issues with sugar as well for El Nino. We can see weaker production, we can see issues in Brazil. So really, if you're looking at potential correlations between the two and similarities, well, you could argue El Nino is that event that brings these two commodities together. And indeed, a very difficult time for chocolate companies, given the fact that these are two of the main components of many chocolate bars. So it's a difficult time to manage risk right now.
Yeah, I mean, so we've spoken about supply, but obviously with the higher prices of cocoa and sugar, those costs will eventually have to be passed to the consumer if they haven't already. How's demand shaping up?
Yeah, no, exactly. You're completely right. Those costs will have to be passed on to the consumer. I'm not entirely sure we've seen the full extent of that pass on yet. I'd say to some degree that a lot of these chocolate companies have likely absorbed some of the costs themselves. They were also likely well hedged last year and potentially had some stocks built up themselves. But really, at this point, they are, fully they're really seeing the full commodity prices, and they're very much, likely we are going to see those prices have to be passed on to consumers.
Yeah.
Now, in terms of demand, if we're looking at the grind data, we saw the EU, North American, and Asian grindings combined were down in Q4, but they weren't hugely down. Maybe not as much as you'd expect, given the fact that we have these, all-time high commodity prices. But in my view, part of that is because, like I say, I don't think we've seen the full extent of this passed on to the consumer. I think really it will be in the later half of this year that we begin to see very, very high prices, more sticker shocks, and sales move away from the supermarket.
I didn't get chocolates yesterday, Paul, so I'm thinking maybe demand has started to kind of wane a little bit. That's just my personal experience. I want to take
Me too.
I want to take the conversation to the broader soft commodity space. I mean, I think
Sure.
the last real big risk event was the Russia-Ukraine war, where we saw soft commodity prices rise. Has that softened significantly, and is the market now fully okay with the war, that it's not going to cause any further price surges anytime soon?
Yeah, I think this is a really interesting point at time that we're having this discussion if looking at the soft commodities market. So on the one hand, we have the likes of cocoa and sugar, which you could argue are fairly bullish. But then if we look at the grains and oilseeds, for example, wheat, corn, and soy, we've actually turned fairly bearish on these commodities looking at our 2024 outlook. So really what we saw was, yes, we had the initial supply shock of the Russia-Ukraine war. We saw Ukrainian wheat exports impeded, for example, last year. And then we also saw issues with Russian exports. But what we're beginning to see now is that through the Ukrainian grain corridor, we're seeing more volumes exported. And Russian exports have actually been very, very strong because they actually had very good production. So we're seeing a lot of the supply issues subside. Risk is leaving the market. And if you look at the futures prices for those commodities, they've really cratered down. Now, I think what is interesting, and what we actually noted last week in a report, is that we look at the CFTC positioning. So we look at the managed money positioning, or hedge fund positioning, or speculators, should I say, within these grains and oilseeds markets. And specifically for grains and oilseeds, what we'll see is that the net short is close to an all-time record right now. So clearly funds and speculators are very, very bearish on these markets. And then on the flip side, we're seeing more bullish sentiment for the likes of cocoa and sugar. So really that's sort of where we're currently at in the market. Reduced risks for grains and oilseeds, higher risk for those commodities that we were discussing earlier.
All right. Well, another risk event that is plaguing the markets right now is the Red Sea crisis. We are out of time. Maybe next time we can actually delve deeper into that. Thank you so much for your time and for your insights today, Paul. That was Commodity Analyst at Rabobank, Paul Joules.